Welcome to Askprep, your trusted companion for UPSC and IAS preparation. Today, we will explore a significant topic in general knowledge: banking in India, banking committees, and banking reforms. Understanding the structure, committees, and reforms in the Indian banking system is crucial for grasping the country's economic landscape and its financial governance. This knowledge is vital for UPSC and IAS aspirants, as banking and finance play a crucial role in India's growth and development. So, without further delay, let's get started. Introduction: The banking sector in India is the backbone of the country's economic system, facilitating the mobilization of savings, credit allocation, and financial inclusion. It operates under the regulatory framework of the Reserve Bank of India, RBI, which ensures the stability and efficiency of the financial system. Over the decades, Indian banking has evolved from traditional brick-and-mortar operations to a dynamic, technology-driven ecosystem that caters to diverse economic needs. From the nationalization of banks to recent digital banking initiatives, India's banking reforms and policies have focused on expanding financial access, improving efficiency, and maintaining economic stability. Understanding the structure, roles, and reforms of the Indian banking system is essential to comprehend its pivotal role in the country's economic development. Banking in India: The banking system in India forms the backbone of the nation's economy. It plays a pivotal role in mobilizing savings, providing credit, and ensuring financial inclusion. Over time, the Indian banking sector has evolved from a colonial framework to a diversified and technology-driven system. Structure of the Indian banking system: commercial banks, public sector banks, PSBs, banks where the government holds a majority stake, example SBI, Punjab National Bank. Private sector banks, owned and operated by private entities, example HDFC Bank, ICICI Bank. Foreign banks, operate in India with branches, example Citibank, HSBC. Regional rural banks, RRBs, established to meet the credit needs of rural and semi-urban areas, especially for agriculture and allied sectors. Cooperative banks, operate in rural and urban areas to support small-scale businesses, farmers, and self-employed individuals. Development banks, specialized banks for long-term financing in sectors like industry and infrastructure, example NABARD, SIDBI. Payments banks and small finance banks, payments banks, example Paytm Payments Bank, focus on small savings accounts and digital payments. Small finance banks, example Ujjivan SFB, cater to underserved sections like small businesses and low-income groups. Banking committees have been instrumental in shaping the banking system through recommendations for structural reforms, financial inclusion, and governance. Narasimham Committees, 1991 and 1998. Objective: to overhaul the Indian banking sector. Key recommendations: Introduction of capital adequacy norms to ensure financial stability. Reduction in non-performing assets, NPAs, through better loan monitoring systems. Privatization of public sector banks to improve efficiency. Encouragement of consolidation to create globally competitive banks. Deregulation of interest rates for better resource allocation. Rangarajan Committee on Financial Inclusion, objective: to expand banking access in rural areas. Key recommendations: Expansion of rural branches and infrastructure. Promotion of self-help groups, SHGs, for small credit needs. Use of technology for last-mile connectivity. PJ Nayak Committee, 2014. Objective: governance reforms for public sector banks. Key recommendations: Reduce government ownership in public sector banks to below 50%. Professionalize bank boards to ensure better decision-making. Establish a bank investment company, BIC, to act as a holding company for government stakes. Basel Committee recommendations, objective: global standards for risk management and financial stability. Adoption in India. Implementation of Basel III norms for capital adequacy and liquidity management. Usha Thorat Committee on Urban Financial Inclusion, objective: enhance access to banking for the urban poor. Key recommendations: Encourage business correspondents, BCs, to operate in urban areas. simplify account opening processes through relaxed KYC norms. Major banking reforms in India. The Indian banking sector has undergone significant reforms over time. These reforms address challenges like inefficiency, financial inclusion, and the management of NPAs. Pre-independence reforms, establishment of Presidency Banks, Bank of Bengal, Bank of Bombay, and Bank of Madras. Formation of the Imperial Bank of India in 1921, which was renamed the State Bank of India, SBI, in 1955. Nationalization of banks, 1969 and 1980 objective, to improve rural credit and ensure access to banking for all. Reforms. In 1969, 14 major private sector banks were nationalized. In 1980, 6 more banks were nationalized. Focus on priority sector lending, including agriculture and small industries. Post-liberalization reforms, 1991 triggered by the economic crisis of 1991. Key initiatives included privatization and entry of new private banks like HDFC Bank and ICICI Bank. Deregulation of interest rates for market-driven credit allocation. Opening up to foreign direct investment, FDI, in the banking sector. Financial inclusion reforms, Jan Dhan Yojana, 2014. Aimed at universal banking access by opening accounts for unbanked households. Aadhaar-enabled banking. Use of biometric identification for seamless transactions. Introduction of payments banks and small finance banks to cater to underserved sections. Insolvency and Bankruptcy Code, IBC, 2016, streamlined the process for resolving bad loans and NPAs. Encouraged faster recovery of stressed assets, improving banking efficiency. Public sector bank mergers, 2019 to 2020 objective, consolidate banks to create stronger, globally competitive entities. Key mergers included Punjab National Bank with Oriental Bank of Commerce and United Bank of India. Technological reforms, adoption of core banking solutions, CBAs. Growth of RTGS, real-time gross settlement, NEFT, National Electronic Funds Transfer, and UPI, Unified Payments Interface. Promotion of digital wallets like Paytm and Google Pay for cashless transactions. Challenges in Indian banking, non-performing assets, NPAs. High levels of bad loans hinder banks' ability to lend, affecting their profitability and stability. Corporate governance issues, political interference and lack of autonomy in public sector banks lead to inefficiencies and weak decision-making. Financial inclusion gaps. Despite initiatives like PMJDY, large sections of the rural and underserved population still lack access to banking services. Cybersecurity risks. The increasing reliance on digital platforms makes the banking system vulnerable to cyber attacks, leading to potential financial fraud. Capital adequacy. Insufficient capital, particularly in public sector banks, poses a risk to financial stability, limiting their ability to withstand shocks. Regulatory and legal challenges, delays in the enforcement of regulations and slow judicial processes hinder effective banking operations and reforms. Operational inefficiency and technological gaps. Many banks, particularly public sector ones, still rely on outdated technologies, affecting service efficiency. In conclusion, the banking system in India is crucial for the country's economic stability, growth, and financial inclusion. Over the years, various banking committees have provided valuable recommendations to strengthen and reform the sector. These include the Narasimham Committees, Raghuram Rajan Committee, and the P.J. Nayak Committee, each contributing to the evolution of India's financial sector. The banking reforms initiated over time, from nationalization to the introduction of Basel III norms, have played a significant role in improving the resilience of the banking system. Initiatives such as financial inclusion and digital banking have broadened access to banking services, ensuring that more people are included in the financial ecosystem. For UPSC aspirants, understanding these banking reforms, committees, and their impact is essential for answering questions related to India's economic governance, financial stability, and monetary policy. A comprehensive understanding of the banking system will not only help in the mains exam but also in developing a nuanced understanding of India's economic framework. At Askprep, We aim to bring such insights to help you prepare better for your UPSC and IAS examinations. Thank you. This is Askprep, your guide to mastering UPSC and IAS preparation. Let's decode complex topics and simplify your journey to success.